Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey Prime investors, Martin Maxwell here, and welcome back to the 5-Minute Prime Podcast. Although today we're kicking off a brand new series that's so important, we're going to need a little more than 5 minutes. We're going to be talking about the single biggest financial instrument most of us will ever encounter, the mortgage. With interest rates becoming a huge topic of conversation again, it's more critical than ever to understand how they truly work. So, over the next 4 weeks, we're going to demystify mortgages from the ground up. We'll explore where rates come from, how to get the best deal, and how they shape the entire real estate market. Today, we start with the absolute fundamentals. We're opening up the borrower's toolkit to understand the moving parts of your own loan. What are you really paying for every month? What's the difference between all those confusing acronyms? This is the foundation. Get this right, and you're already ahead of the game. Let's get into it. When you get your first mortgage statement, it's easy to just look at the total and think, okay, that's what I owe. But a savvy investor knows exactly where their money is going. The best way to think about your mortgage payment is like a 4-slice pizza, and we call it PITI. That's P-I-T-I. The first and most important slice is principal. This is the portion of your payment that actually pays down the money you borrowed. Every dollar of principal you pay increases your equity, your ownership stake in the home. It's the part that's truly building your wealth. The second and often largest slice is interest. This is the fee you pay the bank for the privilege of using their money. In the early years of your loan, this slice is huge. Most of your payment is just feeding the bank. But as you pay down the principal over time, this slice gets smaller and smaller. The third slice is taxes. This is for property taxes, which your lender collects from you each month and holds in an escrow account. Then when the bill is due, they pay the local government on your behalf. It's convenient, but it also means if your property taxes go up, as we discussed back in episode 40, your monthly mortgage payment goes up too. And the final slice is insurance. This typically covers your homeowners insurance premium, which, like taxes, is held in escrow and paid for you by the lender. And in some cases, if you put down less than 20%, it also includes private mortgage insurance, or PMI, which protects the lender, not you. So when you see that monthly payment, don't just see one big number. See the 4 slices: principal, interest, taxes, and insurance. Knowing how that pizza is divided is the first step to financial clarity. Okay, this next one is a classic point of confusion, and it's where a lot of people get tripped up. You see an ad for a mortgage with a super low interest rate, and you get excited. But then you see another number right next to it called the APR, and it's always a little bit higher. What's the deal? Think of it like buying a car. The interest rate is the sticker price. It's the straightforward cost of borrowing the money expressed as a percentage. It's what's used to calculate that interest slice of your PITI pizza. But the APR, which stands for annual percentage rate, is the total out-the-door price of the car. It includes the interest rate, but it also rolls in most of the other fees the lender charges you to get the loan. We're talking about things like loan origination fees, closing costs, and mortgage points. The Consumer Financial Protection Bureau, or CFPB, requires lenders to show you both numbers so you can get a more accurate apples-to-apples comparison of different loan offers. Why is this so important? A lender might offer a rock-bottom interest rate to get your attention, but then tack on a ton of fees. Another lender might have a slightly higher rate, but much lower fees. By comparing the APR, you're comparing the true cost of the loan over its life. So, your takeaway is simple. When you're shopping for a mortgage, always use the APR as your primary point of comparison. It gives you a much more honest picture of what you'll actually be paying. All right, let's talk about the final piece of the puzzle for today, the 2 main types or flavors of mortgages you'll encounter. This is a huge decision, and your choice will have a major impact on your financial life. First, you have the classic, the old reliable, the fixed rate mortgage. This is exactly what it sounds like. The interest rate is locked in for the entire life of the loan, whether that's 15 or 30 years. Your principal and interest payment will never change. The pros are obvious: stability and predictability. You know exactly what you'll be paying every month forever. It makes budgeting easy and protects you from rising interest rates. The con is that you'll typically pay a slightly higher initial interest rate than you would with an adjustable rate loan. The second flavor is the adjustable rate mortgage, or ARM. An ARM usually offers a lower fixed interest rate for an initial period, commonly 5, 7, or 10 years. After that teaser period ends, the rate adjusts, usually once a year, based on the broader market conditions. The pro is that lower initial rate, which means a lower monthly payment for the first few years. This can be very attractive, but the con is a big one: risk. If interest rates have shot up when your adjustment period hits, your monthly payment could increase dramatically, a phenomenon known as payment shock. So, who are ARMs for? They can be a strategic tool for investors who have a clear plan to sell or refinance the property before the initial fixed period ends. But if you're a long-term buy and hold investor, the stability of a fixed rate mortgage is often the safer, more prudent choice, especially in a volatile rate environment. So, the key takeaway for today: understanding the basic building blocks of a mortgage, PITI, APR, and the difference between fixed and ARM is not just boring financial homework. It's the foundation of the P in our prime framework. Preparation. You can't make smart investment decisions without first understanding the mechanics of your financing. Your challenge today: pull up an online mortgage calculator, plug in a sample home price for your area, and toggle between a 15-year and a 30-year fixed loan. Look at the difference in the monthly payment, but more importantly, look at the total interest paid over the life of the loan. See for yourself how much that longer term really costs you. It can be a truly eye-opening exercise. Next week, we're going to pull back the curtain and look at the giant forces that control the entire market. We'll answer the question: where do mortgage rates actually come from? And why do they seem to follow that mysterious 10-year treasury note? You won't want to miss it. Thanks for tuning in. I'm Martin Maxwell. Keep learning, stay strategic, and keep building one smart move at a time.